retail sales tax collections. And so consumers right now are, this is my little slide on consumer confidence meter. You can see, this is where they used to be, and we've swung back. And the question is have we started to swing forward again, or are we still on our way towards panic? U.S. consumer confidence numbers. This is national consumer confidence. Look at this number. It's the second lowest in U.S. history since they've been doing these numbers. We haven't seen this since 1980, since the last oil embargo, oil crisis. We haven't seen numbers this low. And so what happens when consumers don't have confidence? They pull back on their spending. In fact, a lot of the spending that was going on here wasn't from wage growth, wasn't from consumers having more money. In a lot of cases, it was consumers using their homes as credit cards. They would get them a second or a third or HELOC, and they were going out and buying tennis shoes and TVs and new cars and that type of thing. And so that drove a lot of consumer confidence. Obviously, that's gone. Those things are being locked down. Anybody that has a HELOC has probably seen them shut it off and fix it in a lot of cases. This is making homeowners nervous. Even though they're in their home, they're seeing their neighbors get foreclosed. They're seeing, they can't believe what's going on in the foreclosure market. And this is part of what's driving the deflation in housing values has to do with the fact that the banks are in very tight situation. So when they have a foreclosure, they want to sell it right away. They got to get this thing off their books. And so they're saying, I was actually at a meeting speaking, I was giving the same presentation to a group of folks that worked in the foreclosure industry. And they were being told that you had 30 days to sell every property that you were given, or else you were no longer given any properties by that financial institution. You're basically fired as a broker. And so what are they going to do? They're going to price it to make sure it moves in 30 days, or else they're out of business. And so that's driving more of the deflation that's going on. Yes.
I just wanted to ask you about some situations that I know have happened to some of my constituents down in the valley, and it has to do with them not being able to meet their commitments on their home, make their payments. Mm-hmm. And when they've gone into the banks to see if they could reconfigure their loans or do whatever they need to do to try to be current, the banks weren't very willing to work with them. And they were getting behind, but yet the banks, they're staying in their houses 6, 7, 8 months without paying anything before they are forced out. And so a lot of people are just taking advantage of that and doing that.
That's happening quite a bit, where you've got people, because the foreclosure departments within the banks aren't big enough to handle the volume of foreclosures. And so that's, for example, when they're so far behind, they're not getting around to doing the foreclosure because they just got too much of a backlog. And that's happening where people are getting 6 months without paying rent. That's making the problem worse. It's not actually helping the situation because that's, the banks are, when they get to it, they're wanting to get rid of that property right away. This is starting to change. There's been a lot of pressure from the federal side. There's something the Fed had worked out to try to encourage the financial institutions that created the mess. And in a lot of ways, I really want to hand it to Paulson. He's really stepped out there and tried to force, rather than having a bailout where the government actually pays those mortgages, he's actually been putting pressure on, and Schwarzenegger actually came up with the idea in California and started it, and Paulson basically copied this, to try to force those financial institutions that made those teaser high-rate loans to redo those loans and accept something that they can actually pay. And there's a federal hotline number associated with that program. I don't have it committed to memory, but we can get it for you that you can distribute to your constituents, because we really need these banks. We don't need more foreclosures. That's only going to make the problem worse. What we need is these financial institutions to realize, you're better off getting 80, 90% of your mortgage paid by somebody that's there than putting it out on the foreclosure market and getting 60, 50 cents on the dollar by the time everything's done. And that would help our situation a lot. And some of the financial institutions are now starting to get that, understand that concept. They were very worried and leery about doing that before, but they're starting, because that's kind of counterintuitive from the way they've always dealt with things, but they're starting to move around. But some financial institutions are more flexible than others. Some financial institutions are in such bad shape themselves, they don't have a lot of flexibility. And part of that's due to the new accounting requirements that are going on. Was there another question?
And I just wanted to comment, I didn't understand why the banks were being so obtuse about working with these people that want to stay in their homes and are more than willing, if they'll just kind of help them, I don't know, refinance or whatever, they could afford to make lesser payments and stay there, but they won't even talk to them. And that's what was really disconcerting to me.
And, right now, I would, a year ago, you would want, 2 years ago, you'd want to invest in those that were on the in the real estate side. This time, the good place to invest your money is on the foreclosure side, because they're just swamped with business. And that's a lot of times what a lot of people are experiencing is when they're trying to talk to the foreclosure side of the bank, they're just so busy. They don't have to, I don't say they don't have to be nice, but they're too busy to really go through a lot of these things. This is another scary statistic. This is the national numbers for delinquencies. These are people that are behind on their mortgages. This is an all-time high that we've ever seen. The last time we were this high was right before the last real estate, and that was back in the mid 80s. And so now we've seen it even higher than this. That's over almost 6.5%. And I think it's going to even go higher when we get our new numbers that come out. That's 6.5% of all the homes in the United States are behind on their mortgages. Yes.
I think it's very interesting, though, that this problem came about. You call them teaser, don't forget. People were still getting into homes, buying property, so there are no things getting into that were buying the bubble first, and then everybody starts buying it because it seems to be doing well. The government needs to pull everybody out. The problem that I see is that we have this unbelievable mortgage that only brings everything else. The government comes in and steps in and
The worst thing you can do is have the government start making people's house payments, because that's not going to solve the problem. That's essentially what Japan did when they had their crisis back in the 90s. Their federal government stepped in, and what it did is it prolonged the pain, and it made things worse. It's kind of like picking at a Band-Aid rather than ripping it off. What really happened? Why did we get into this mess? I mean, how exactly did this happen? Well, let's think back. What was the good old days when you used to try to buy a home? They did this, fiscal anal probe where they checked you from stem to stern. They wanted to make sure you were going to be there to pay that final payment in 30 years, and it was going to be good because they were going to hold the note that entire time. And that was the thought process. Well, there's always been securitization of mortgages, but that became a real large fad over the last decade, really. And what it was is instead of the bank issuing the mortgage and holding it forever, they would package them together, and they put a bunch of mortgages together, and they'd sell them off on Wall Street to institutional investors, like governments, like insurance companies, like anybody else who has lots of money. We sold a lot of these to Europe and Asia, as well as investments in U.S. U.S. mortgages, U.S. homes, and that was all fine and good as long as they were packaging the prime loans together and the Alt-A's together and the subprimes together, and so people knew what the risks they were taking. What really happened, though, was they started packaging together. They would take some of the subprime, some of the Alt-A, and some of the jumbos, and they put it in with the primes, and they'd package it all together, and the mortgage would still get an A rating. The security would get an A rating, even though you had some really bad stuff, real high risk stuff in there. Well, they threw that in there to help increase the returns. And so a lot of the investors, like Florida, like Orange County, weren't looking past the rating. Oh, it's an A-rated security, that must mean all the mortgages are A in there. Well, that wasn't what was going on. And so when the housing bubble burst, at first the markets didn't realize it. They didn't catch on. Well, what occurred in the housing industry is this securitization became popular. It became really easy to sell off these mortgages. You started to move away from the traditional bank necessarily